A simple one ETF portfolio can be an easy way to build massive wealth without making investing overcomplicated. And in this video, I'll be breaking down the one ETF portfolio that's worth buying and holding for the long term. Quick reminder, this video is for educational purposes only. This is not financial advice and I'm not a financial advisor. All investments carry risk, so always be sure to do your own research before making any investment decisions. First, let's talk about why you'd invest in a one ETF portfolio. A one ETF portfolio removes a lot of the noise from investing and makes it as simple as can be. You're not trying to manage, keep up, and rebalance multiple funds. You're just buying one fund and that's it. This can be a great option for those of you who want to be invested, but feel as though you don't have the time, experience, or maybe no interest at all to look into different ETFs and compare them. And something important to keep in mind is that having more ETFs doesn't mean that you're more diversified. Oftentimes, people will have more ETFs, making things more complex with no real benefits. By choosing the right broad market ETF, one fund can give you everything that you need. And by that, I mean exposure to hundreds or thousands of companies in the US and across the entire world. A broad market ETF lets you own a big chunk of the stock market, or some cover the entire market. These type of funds track large indexes like the S&P 500, which is the largest 500 companies in the US. You have the total US market, or also the global or world market. This diversification is a huge benefit as an investor because it lowers your risk and offers a higher level of protection. For example, if one or a couple of sectors are struggling, the strength from the other sectors could help to balance it out or offset it. And the same case if US markets are taking a tumble while international markets are doing well, it reduces the impact since you aren't concentrated in one country, market, or even sector. At the end of the day, broad market ETFs have a strong historical track record of providing growth and consistent returns over the long term through so many different types of market conditions. This brings me to the power of investing globally. With the US making up around 60% more or less of the world's stock market value, that leaves a nice chunk of opportunity outside of the US. History has proven that different markets perform better at different times. Sometimes the US is leading, and other times the international markets are outperforming, which is the case right now. And by having global exposure, there's no need to guess or predict what will do better and when. So I picked 4 of the best world ETFs that could be used for one ETF portfolio. So let's get into what they are and how they compare. Now let's dive into the different global broad market ETFs for one ETF portfolio. First, I'll get into what each fund is, then I'll be comparing them across a few different categories to see what stands out. First on the list is VT, the Vanguard Total World Stock ETF. This fund tracks the FTSE Global All Cap Index and it invests in the entire global stock market. This includes large, mid, and small cap companies, not only in the US, but in developed and emerging markets outside of the US. So you'll be invested in pretty much everything, all sizes of companies across the entire world. Next is spgm, the Spider Portfolio MSCI Global Stock Market ETF. This fund tracks the MSCI ACWI IMI Index, which also invests in a wide range of global stocks. And it includes large, mid, and small cap companies in and outside of the US. But this fund is slightly different from VT because it holds a selection of stocks from the index that it tracks, and the goal is to behave similar to the entire index when it comes to risk and returns. Next up, we have urth, the iShares MSCI World ETF. This fund tracks the MSCI World Index, which invests in large and mid-cap companies in developed markets. So unlike the previous 2 ETFs, this fund is not giving exposure to the smaller companies, and it isn't investing in emerging markets. And last up, we have DGT, the Spider Global Dow ETF. This ETF tracks the Global Dow Index, which is focused on investing in 150 leading companies from around the world. This fund invests in both the US and emerging and developed markets outside of the US, but it's much more selective in its choices than the other ETFs that we have on the list. These stocks are picked not just based on their size and their reputation, but also on their importance in the global economy. And the index is equally weighted in its holdings, which I'll get more into shortly. So now that you have an idea of the 4 ETFs, let's get into the details of their differences and see how they compare. The first category for comparison is diversification. For VT, this ETF currently holds a total of 10,000 stocks, so it comes packed. And its top holdings are in companies like Nvidia, Apple, Microsoft, Amazon, Google, and more, which make up about 21% of the portfolio, so not too heavy in these big names. For the sector exposure, technology makes up about a quarter, then financials, industrials, consumer discretionary, and healthcare. And for the countries, it's mostly exposed to the US, Japan, the UK, China, Canada, Taiwan, and others, which you can see VT is balanced across its sectors and it's wide in its exposure to companies and countries. For spgm, this ETF is holding around 2,914 stocks currently, with top holdings in Nvidia, Microsoft, Broadcom, Google, Meta, and more making up about 20% of the fund, which is very close to VT with just less holdings. For the sectors, we have technology up top, financials, industrials, healthcare, and a handful of other sectors. Looking at the top 10 for country exposure, the US is going to be at the top, then Japan, the UK, Canada, China, and a few more. Moving on to Urth, this fund currently has 1,319 holdings. And the top holdings are in similar names like Nvidia, Apple, Microsoft, and more, but they do have one that's different, and that's JP Morgan at the bottom. Also, this fund's top holdings make up 25% of the portfolio, so slightly more weight than the other two funds on this list. For sectors, Urth is mostly exposed to technology, then financials and industrials, with the remaining spread in a few other sectors. And for the countries, the US is about 70%, with the rest in Japan, the UK, Canada, France, Switzerland, and more. And remember, this fund doesn't give you exposure to emerging markets like China, India, and others. Last, we have DGT, which only has 154 holdings, with its top holdings in companies like ArcelorMittal, ASML, Intel, Caterpillar, FedEx, and more that make up about 10% of the fund. Due to the equally weighted spread in the holdings, no stock is heavily weighted. For the sector exposure, financials makes the top, then technology, industrials, healthcare, and more, which looks to be pretty well balanced overall. For country exposure, the US is just over half, then Japan, the UK, and France, so less weight in the US, allowing for more exposure to other countries. Now I'll be ranking these categories on a scale of 1 to 10, with 1 being the absolute worst and 10 being the best. Starting with VT for diversification, I'm going to have to give this one a 10 out of 10. You just can't get more diversified with stocks when you're holding nearly 10,000 companies from all around the globe. spgm is next, and it's going to get a 9.5 out of 10. It's still very well diversified, but a more trimmed version of VT. For Urth, I'm going to be giving it a 9 out of 10. It still has good coverage with around 1,300 stocks focused on developed markets and skipping out on emerging. And last, for DGT, I'm giving this one an 8.5 out of 10. While yes, it does only come with 150 stocks, but these are solid companies, and the equal weighting removes the risk of having high concentration in certain stocks, making it very well balanced, which is something that the other funds don't offer. This next category up is going to be volatility and risk. For this one, we'll be going over the beta and the largest drawdowns that each of these ETFs have experienced over the last 10 years. And if you don't know what beta is, it's the measure of the risk or volatility of an investment compared to the overall market. The S&P is essentially the standard, and it has a beta value of 1. Anything below 1 will be less volatile and risky, and above 1 is going to be more volatile and carry more risk. Starting with VT, it comes with a 10-year beta of 1.02, and the largest drawdowns were minus 25.5%, minus 22.1%, and minus 14.4%, with its worst year in 2022 ending with minus 17.5%. For SPGM, it has a 10-year beta of 1.01, and for the drawdowns, we have minus 24.2%, minus 21.6%, and minus 14.1%, with the worst year in 2022 ending with minus 17.9%. For Urth, it has a beta of 1.02, and drawdowns of minus 25.4%, minus 21.1%, and 13.2%, with 2022 being the worst year, ending with minus 18%. And last, DGT, the beta is 0.99, and the drawdowns were minus 23.9%, 22.8%, and 14.2%. And unlike the others in 2022, it ended the year better, down about only minus 8% in comparison, And its worst year was actually in 2018 with minus 9.6% returns. The beta is very close for these funds, with DGT just barely coming under 1 and the others a bit higher because of their larger holdings. And when we look at the differences in their drawdowns, they're very close as well. But VT is slightly higher, which we can attribute most likely to having more exposure to a variety of emerging market stocks and its top 10 holdings. The same for urth, which actually is the heaviest in its top holdings in names like Nvidia, Apple, Microsoft, and others. So no surprise there, because when there are dips, it's going to get hit a bit harder. The drawdowns for DGT were the best, and you can see for the year that was ending in 2022, the other funds dropped nearly 10% more, and the equal weighted portfolio of DGT provided some better downside protection there. For this reason, VT is going to be getting an 8 out of 10, spgm is also going to be getting an 8, urth I'll give a 7.5, and DGT, I have to give an 8.5 since that equal weight is kind of a big deal. And none of them are going to be getting a perfect 10 here since they're all made up of only stocks. For the best part, and I think you might be surprised on this one, we have performance. Getting to it with VT, this fund has had 5-year annual returns of around 11.7% and annual returns over the last 10 years of about 12.8%. So some pretty solid results. And international has recently been outperforming the US market. To show you the impact that it's had on the fund, in the last year, VT had returns of over 20%. It also comes with a dividend yield of 1.75% that's paid out quarterly, and it has an expense ratio of just 0.06%, costing $6 for every $10,000 invested. For SPGM, this fund did a bit better with 5-year annual returns of over 12%, and annual returns over the last 10 years of about 13%, which is nice. So this fund, being basically a trimmed down version of VT, was able to squeeze out slightly higher returns. And SPGM has a dividend yield of 2.6%, which is paid out every quarter, and it comes with an expense ratio of 0.09%, costing you $9 for every $10,000 invested. Next is urth, and this ETF has had 5-year annual returns of 13%, and annual returns of a bit over 13% over the past 10 years. While this fund has done better than the other two, something to consider is that urth focuses on developed markets only, and it doesn't invest in small caps, so just mid and large caps. It also leans more into the US in general, so the longer term performance is better, but since international has been on a run recently, the ETFs with more international exposure have performed better. Now, for the dividends, urth has a dividend yield of 1.4%, which is paid out quarterly, and it comes with an expense ratio of 0.24%, costing $24 per 10K invested. Then for DGT, this fund has had 5-year annual returns of about 16% and annual returns of over 14% in the last 10 years, which I have to say it has been doing very well. And given the limited amount of holdings and the fact that it's equally weighted, would have probably made you think that it would have been the weakest by not having that large tech exposure. For the dividends, DGT has a dividend yield of 2.6%, which is also paid quarterly, and it comes with the highest expense ratio of 0.5%, but keep in mind that these expense ratios are included in the returns of these ETFs. And to give you a better idea of the performance between them, here's the returns over the last 10 years. You can see DGT is ahead by quite a bit, and the others are closer together, with urth in second. Looking at the last 5 years, it's a very similar outcome that we saw in the 10-year chart, with DGT up top and VT last. And looking at just the last year alone, you can see that all these funds did well. DGT came out on top, and this time urth is falling in last. So when it comes to the performance, I'm going to be giving VT a 7 out of 10, while it's the most diverse in its top holdings that didn't help it in returns compared to the others. SPGM is getting a 7 since it did slightly better than VT, and urth comes out ahead of those two with a 7.5 thanks to its developed market focus and since it's more US tilted. And the best here is DGT with an 8 out of 10 for the solid returns that it's managed to provide. And not that this is an equal comparison, but DGT managed to have even higher 5-year returns than the S&P 500. Now we're going to get into how these ETFs compare to each other across all the categories. And this isn't about what ETF is the best no matter what, but instead it's highlighting the strengths and weaknesses that a fund might have and and how that fits into your investing strategy. With that being said, based on the scores, VT has 25, SPGM is going to have 24.5, urth comes in with 24, and then DGT comes in with a tie at the top with 25 points. Both of these funds win for slightly different reasons, and overall, you can see that these ETFs have many similarities. VT, without a doubt, is a top choice for diversification. You get the most amount of holdings, and it includes all sizes of companies. With that though, it does come slightly weaker in the returns, but it's not too dramatic. While SPGM chooses a subset of stocks from its global index, to me, it's like a trend version of VT and is going to have less of the smaller companies. urth is a bit less diversified, but not because of the holdings, but since it only invests in developed markets, plus it leans more into the US stocks and its top holdings. If US markets are running and international isn't, it's going to have a slight edge there. DGT, on the other hand, is a much more refined ETF that leans away from the big mega cap tech names that you find in the other three funds like Nvidia, Apple, and others. And while it doesn't hold as many stocks, the index holds solid names worldwide with an equal weight, providing some real balance in a way. Now, if you're looking for an all-in-one package that's simple to manage and has great diversification, a one ETF portfolio is a great option to consider. But if you want to have a little more control in your holdings and how much you invest in international, growth, or other assets, and you still want to maintain some solid growth potential, then you should watch this video here on the 6 ETFs that you can combine with VU to build some serious wealth. And if you made it to the end, I really appreciate you watching. Be sure to tap that like button and subscribe to stay up to date on content, and I'll be seeing you on the next one.